In the previous chapter, we saw that contrarily to common beliefs, generating sales turnover is not sufficient enough to succeed. Thus, what is the company running after? What for? Who for? What is the value creation? How do we measure it? Are there prerequisites to value creation? How can the manager increase the required value creation by his daily decisions and actions? This module includes 3 chapters. In the first one, we will study the weighted average cost of capital, WACC. Then, in the second one, we will see what the value creation is, and how to increase it in the last one. At the end of this module, a summary will be presented to you, as well as many quiz to let you test your knowledge. The goal of this module is to give you the keys to better the company's value creation. The mission of the operational teams is to keep on improving ROC, which is equal to the product of the assets turnover ratio by the operating margin. To do so, there are 2 ways. The first one consists of increasing the ratio of assets turnover ratio. The second one consists of increasing the operating margin. Let's start with the first solution, which consists of increasing the ratio of asset turnover ratio. That is to say, sales to the sum of non-current assets plus WCR ratio. The first option is to increase sales level for each euro invested in economic assets. The second option is to decrease the non-current assets, in other words, by deciding whether to make or buy, by eliminating non-operating assets or unproductive assets, by reducing WCR to the minimum, that is to say, by collecting receivables efficiently, by negotiating good terms of payments to suppliers, and by reducing inventories levels to a buffer stocks level. Let's continue with the second solution, which is to increase the operating margin, in other words, recurring operating income to sales ratio, which represents the profit delivered by the company for any euro of sales made. To do so, several options coexist, such as increase sales while reducing costs, benefiting from economies of scale. Keep on consuming less products and services to produce the same volume of activity, gain on productivity. Permanently look for skills development. Permanently foster creative spirit that allows for innovation throughout the organization. All this in order to get a bigger price elasticity for an even better value proposition offering to customers. In order to test your knowledge upon the value creation approach, I suggest you a little quiz. Shall we? You have to say if the following statement is right or wrong. WACC, weighted average cost of capital, is defined as the average cost of debt only.
WACC, weighted average cost of capital, is the sum of the cost of all financial resources used by the company, i.e., equity and debt, and is used as a reference to estimate the return required by each of the fund's providers.
You have to say if the following statement is right or wrong. An investment will be qualified as financial viable if it generates a return higher than the cost of capital used to fund it.
Well done! You found the right answer. To be financially viable, an investment should generate a higher return than the cost of capital used to fund it. ROS is greater than WACC.